Once again, we await with bated breath the non-farm payroll figure. The markets are on hold for this one. But what do we expect? Well, we've got Marc Ostwald just here to talk to us about it from ADM Investor Services International. Thank you very much indeed for your time. So just want to mention the fact that the ADM number is a day later today because of Memorial Day, the holiday. Does that make any difference? Because it's the precursor, because it's a day later? Or not necessarily at all? I just wanted to get your take.
Well, in a certain sense, it's a bit of an advantage because you don't have the hiatus day, because normally the day in between becomes a day where people say, well, we've had the ADP, we're waiting for payrolls tomorrow, let's do nothing today.
Okay, so at least people are going to be doing something?
Yes. And
preparing how?
The US labour market is in very, very, very good health. We're expecting a solid number, ADP 180, something around there, non-farm payrolls in the same sort of ballpark. The key aspects, I think, really are more the unemployment rate, which is expected to be unchanged at 4.4%, which is below the level which the Fed basically sees as sustainable in terms of not basically driving an overheating labour market. And most importantly of all will be the average earnings numbers, because those really, for the time being, we're not seeing a spectacular pickup in average earnings, but it is comfortably above 2. It's in the 2.5 range. If we were to see that to start to accelerate, and there are some indications that in quite a lot of industries there are broadening skills shortages, which is encouraging some employers to put up wages a little bit more to retain workers. But at the moment, it's not running at the sort of level which would make the Fed basically say, right, we need to actually start to pick up the pace of our tightening. For the time being, they can actually take their time, particularly given inflation is quite well behaved.
And just to put this into context as well, we had the Beige book comments as well, because they said that US firms, it was broadly upbeat, that was the sentiment, but there were worries in some regions about trade and other government policies.
Yes, I mean, I think this is the other thematic in the States, that we're now 5 months into the Trump presidency, and really not a lot has been achieved. There is the whole stuff around the Russia connection, and we've now got this presumed exit from the Paris Climate Accord. Nothing very positive coming out of the Trump regime, so it's unsurprising, particularly given the sort of rather confrontational aspect of trade with both Canada and Mexico, let alone anywhere else, that is making American companies worry. However, the truth on the ground, when you look at the orders data, is that it's still ticking along very nicely, thank you.
And rate rises? Yes,
I think June is definitely, it's a done deal.
Okay. Is it priced in then?
It is. It's basically priced in. Yeah, it's at 80–90%. What happens thereafter really is going to depend on what happens with inflation above all. For the time being, there is actually a slightly divergent message coming from the Fed, with the dovish people basically going against this idea that there might be one more rate hike after June, because they feel that inflation is a little bit suboptimal. So it really depends on that, and of course that will in turn depend partially on what happens with oil prices.
Okay, we'll leave it there. Thank you very much indeed. That's Marc Ostwald just there. And to let you know, we will have a live show and market reaction when we do get those numbers filtering through. Thank you very much indeed for watching. So we'll be back at 1:30 live here on IGTV on Friday. Goodbye.